All right, just a quick conversation that I've been having with a lot of clients as I do reviews, and I figured I would just record something that we could distribute to folks who work with us, don't work with us, even advisors that are sitting with our clients. So, if you watch financial media, you'll come to realize how fickle the talking heads on TV are and the men wearing makeup. Um, you were hearing this theme of like, we're now in a bull market, right? Because when you look at the trajectory of the stock market to start the year off, depending on which day you look at it, the S&P 500 is up in the teens. And now people are saying the bottom has been set and we're just going to go up from here, even though when you look at PE ratios, like we're clearly not in the .com era, but we're getting closer to it. Um, so I just wanted to dissect the market for a little bit and maybe make a case for what I believe we're in the midst of. I still believe we're in what's called a secular bear market. A secular bear market is summarized as a prolonged period of time where there's pops and drops in the market. And you take a step back and you look at what the stock market did over a prolonged period of time. And we were pretty much stuck in the muck. We were basically flat for a long period of time. And if you look at the market at the beginning of 2022, end of 2021, we have yet to reach that high that we reached at the end of 2021 because obviously in 2022 we spent most of the year in a downward trend. The S&P was down around 20%, Nasdaq down around 30%. And this year the market's kind of surging back up. Like I said, it's in the teens and people are already to anoint this market a bull market. And then I'm watching TV earlier this week as I record this. It's August 10th, and we had like one bad day of trading. And all of a sudden, all of those very same talking heads who were saying we're in the start of the strongest bull market in the history of mankind have completely flipped and are saying, here comes the bear market. Look at valuations. There's a lot of ugly economic headwinds that we need to come to grips with. And I just want to show you a couple things that I'm looking at. One is what I've already showed you. We are in a secular bear market, in my opinion, and I think you're going to see a lot more chop. And you're going to squint your eyes and take a step back and look at this market from a longer, and it's going to come to light that we're kind of moving in almost a flat pattern. The other thing that you guys should all take inventory of is most of the growth within the S&P 500 year to date has been driven by what people are calling the Magnificent Seven, right? So let's look at the components of the S&P 500. If Yahoo Finance will work with me for a second here. Of course, it doesn't work. Let me pull up just SPY. Might work a little bit better for us. Here's our holdings. So Apple, Microsoft, Amazon, Nvidia, Google, Tesla, Facebook or Meta, Berkshire, United Healthcare. You look at these names right here, and you do the math, because the S&P 500, of course, is a market cap weighted index, right? So 13, call it 14, 17, 20, 22, 24, 26. Close to 30% of the S&P 500's price movement is being driven by these names: Apple, Microsoft, Amazon, Nvidia, Google, Tesla. Notice none of these companies are real value names. None of these companies are dividend producers. So it's really been a tale of two cities year to date, right? So if we look at, let me pull up like ticker VUG, Vanguard Growth, which owns a lot of those names I just shined a light on. Look at the holdings inside this thing. Apple, Microsoft, Amazon, Nvidia, Google, Tesla, like those very same names. That Magnificent Seven is all inside this index fund. And year to date, you can see it's up 30%, right? So let's open up the screen and look at this chart. Now, of course, these are the names that were also down 30, 40, 50% in 2022. So here again, they have still yet gotten back to that peak that they reached at the end of 2021. But if you compare this growth fund, let's look at it just over year to date, right? So it's up, like I said, 30%. If you compare that Schwab High Dividend Fund, SCHD, which is one of the components of our dividend driver model. There it is, right? Dividend stocks year to date are completely stuck in the muck, right? So if you own dividend stocks and you're looking at the S&P 500 going, Adam, the S&P 500's up 17% and my dividend stocks haven't moved an inch. Does that mean dividend stocks are a bad investment? I'd argue no. I think when you own dividend stocks, you're kind of less concerned about the month by month, even year by year paper gains and paper losses and price valuation gyrations, and you're more concerned about a consistent dividend flowing to you like clockwork on a month by month basis. So be careful about comparing your investment performance to the S&P 500 when the S&P 500 is so overweighted those magnificent seven. It's so overweighted, being it though it's a market cap weighted index. It's so overweight technology stocks right now. Let me see if I could scan out a little bit. This fund hasn't been around all that long. So if you look at growth names next to dividend names, this of course was 2022. If you own those very same growth names, it's like a roller coaster ride. You're going all the way down, you're shooting all the way up, whereas dividend investors have just kind of chopped along, maintained value, actually outperformed growth names under this period of time. And I'll again, this is something that I'm a bit of a broken record, but I'll fix your eye again on Vanguard's annual economic forecast. We put a lot of weight and merit into this, just because Vanguard's business model is to buy and hang on for dear life, right? Like they want you to buy low cost index funds and just ride the market in the good and the bad. And they've come out and they've made these 10-year annualized nominal rate of return predictions. And they basically said they only anticipate US equities to grow to the tune 4.7 to 6.7% per year. This is the most bearish forecast Vanguard has ever issued. Prototypically, we expect US equity stocks to grow 7, 8, 9, 10% per year. Vanguard's out here telling us we're going to make 4 to 6% per year with equities. In fact, growth stocks, those very same stocks that are performing magnificently year to date, they only anticipate growth stocks to grow to the tune of 3 to 5% per year. In fact, they see cash growing at 3 to 4% per year. So the purpose of this video, we still believe in dividend stocks. Just because they're not outperforming the S&P 500 year to date, I don't think that should sway your investment decision making. I also think people should own Amazon and Google and those names that are still yet innovating and changing the world that we live in. But as retirees, smoothing out the ride, collecting surplus income, a consistent, reliable dividend is more important than trying to time the market magnificently. So just some random musings about the market. Recognize that it's truly a tale of two cities. Growth stocks, value stocks, growth stocks, dividend stocks are having very, very different outcomes year to date. But that doesn't mean one or the other is all right and the other's all wrong. Stick to your plan, stick to the allocation that's thoughtful, and we're going to get through a lot of different choppy markets over the years. But if you make smart decisions, don't do anything overly exotic, buy comfort food, buy stocks that make sense, you'll be on the better end of this, even if we are in a cyclical bear market like I happen to think we're in. Hope this was helpful.